Let's review the primary concerns of individuals approaching retirement, mainly focusing on maximizing Social Security benefits, implementing tax efficient strategies, understanding employer benefits, managing investment returns, and developing effective withdrawal strategies. I want to emphasize the importance of a comprehensive retirement plan that goes beyond your basic investment management, addressing overlooked aspects such as tax implications and the order of withdrawals to enhance financial security in retirement.
This is Retire Ready, where we break down retirement planning and make it easy to understand. Planning your retirement starts now with your host, Kyle Hammerschmidt.
So as I mentioned, let's walk through the primary concerns of most of the individuals that I either talk to, sit down with. So those primary concerns for those that are 50 to 65, or even just like within 10 years of retirement, I have found that number one is like how to maximize Social Security. And I think a lot of households or individuals kind of struggle with what that actually means to them. A lot of times it's like going online, typing into Google, how do I maximize my Social Security? It's going to spit out some answers and some headlines. A lot of Social Security calculators are going to really just like say, hey, wait till 70 or delay your benefits, which is not always the case. So usually the primary concern number one is how do I maximize my Social Security? And I kind of want to walk you through what that potentially might look like. And number two, ongoing tax efficient planning to reduce lifetime tax bills. If tax planning was easy, everybody would be doing it. And I think a lot of us fall into the loop of being a tax preparer or filing taxes and assuming we're doing tax planning. So number two is like, how do we implement some tax strategy to reduce that lifetime tax bill? Not just say, hey, how do I lower my taxes in 2025? And I think for most individuals, I always just kind of joke around and I'd say, all right, you're going to work in 2025, call your employer and basically tell them you're going to cut your pay in half. You're going to go from $180,000 down to $90,000 per year voluntarily. And that will save you in taxes, right? You're going to max out your traditional 401k. You're going to max out your traditional IRA, max out your HSA. You'll deduct a bunch of your income. So that way in the future, you don't have to worry about, you're deducting now, paying the taxes later, and hey, you save money on taxes. But tax planning is usually looking at right now, moving forward over a long period of time. How do we take our lifetime tax bills and potentially save six figures on our federal taxes? And for most of you, if you're listening, watching, if you have seven-figure IRAs and 401k balances, your strategy is pretty much going to consist of, if you basically maxing out Roth 401k contributions or an optimal Roth conversion strategy, would be about 4 to 10 years of Roth conversions to really lower that lifetime tax bill by 6 to 7 figures, avoiding IRMA. So that's another thing. The primary concern is reducing your lifetime tax bill. How do we do that without understanding the pros and the cons? Next is like employer benefit guidance. Pretty common for a majority of your money, or even initially when we're just talking to people before we start working with them. Everything they have is like through their employer plans. It's like 4 old 401ks or everything's in their existing employer plan. They've just rolled everything in, and really helping them guide them on like, one, maximizing your insurance benefits through your employer, but two, just making sure you're maximizing or taking a better approach to like, are you just picking a target date fund? Are you a certain age where you can kind of take money out, put it in the private sector to maximize? So making sure like, it's pretty common where like private sectors, well, my Joe Bob advisor at Edward Jones do my money like this, and they don't give guidance over here. So my employer money is doing this. Everything's not working together. So that's pretty common. Next is aligning all your moving parts of your financial life to just create a successful retirement plan. As you're going to learn today, like retirement planning is more than just a stack of statements with diversified pie chart. Very rarely do we see somebody with a detailed financial plan that encompasses like income planning, spending capacity, spending strategies, how to claim their Social Security, how to keep more over their lifetime, what are their order of withdrawal strategies. Again, most people just have a diversified pie chart and they're going to take out 4%. Next is this maximizing investment returns. before and after retirement, and like minimizing risk. So if we focus on average rates of returns, we could get in trouble. I always just kind of give an example. If I have $100,000 and my portfolio drops 30%, I now have $70,000. I need to make 43% return just to get my money back. So if you do a minus 30 plus 43, that equals a positive 13. If you divide that by 2 years, you've averaged 6.5%, but you still have $100,000. So if we're just going to wing it and say, hey, plug it into these S&P funds through my employer and this target date fund, it's averaged 8%. I'll just be a little more conservative in retirement and average 5. Like average rate of returns is not really how we want to maximize your investments. So we always focus on standard deviation. What's your internal rate of return needed on your portfolio for your plan to have the highest success rates for your goals and spending? Standard deviation is really going to tell you within the highest probabilities of like what's your range of returns you can expect around that average. And then again, focusing on maybe some dividend stocks, dividend yields, or income, just how much income can your portfolio give you without you selling shares. Annual Roth conversion strategies, that's usually a big one once we kind of start talking about that. Is like, sounds great, but how do we do it? Do we just wing it? Do we just do one and we're done? Very rarely are you doing a one-time Roth conversion and you're done. From our experience of building hundreds and hundreds of plans, usually the Roth conversion strategy is going to take anywhere from 4 to 10 years to get everything in place. You're not like rushing it and potentially overpaying up front. So again, Roth conversion strategy is usually in the back of people's minds because most individuals personally believe that federal tax rates at some point might have to go up slightly. The Tax Cuts and Jobs Act is basically going to expire in January 2026. It would sunset. So some tax brackets are going to start going up and standard deductions will start going down. Next is just like order of withdrawals. Like, where should I get my money from? That's the kind of like the traditional way of thinking about it. If I need $10,000 a month in retirement, like, where's it coming from? Where should I pull it from? Should I pull it from all of my buckets at once? Should I pull from my IRAs for 3 years and then start taking my Social Security and pension? Like, how is that going to work? And then really the investment plan prior to retirement. So if you're 5 to 10 years out, how does this strategy work? And then how should I invest in retirement as I approach my fragile decade? That fragile decade is your first 10 years of retirement. And again, those are the most important years. So mainly just kind of trying to stay away from like, should I follow the rules of thumb that say the closer I get to retirement, the more conservative I should be? Or should I just throw my money in a target date 2030 fund because I'm going to retire in 2030? So what does that investment plan look before retirement and after retirement once I start taking some money out? So let's walk you through some ideas and concepts that are often overlooked. So you want to get the information and the education on why you should take a comprehensive approach to retirement that consists of more than just a diversified pie chart and a stack of statements. You also want to look for ideas and strategies that could possibly lower your long-term tax bills in retirement. We just look for strategies out there that can help you spend more early, but also keep more of your income, like Social Security taxation. Does it really make sense to claim a benefit but not understand how it's taxed around your assets, where if you pull too much from your IRAs and your 401ks and not enough from the Roth bucket or capital gains, it actually makes more of your Social Security taxable when you end up just giving more back in taxes. So the goal would be to keep more of your income in retirement. So again, as we said, like probably the 4 things that are like the most overlooked is every specific household has an order of withdrawal strategy of like how they should take money out from their accounts. You need to understand from a spending capacity what's worth most to you after tax net. So understanding that like not all sources of income are taxed the same. Next is like Social Security it's a huge deal. And then for most of you, that's going to move Social Security claiming strategies for most individuals that I put plans together for, just talk to. It really is going to move the needle on your spending strategy. So if your plan is to hopefully spend more early in your early years in retirement, how you claim your Social Security is a big deal. It's also going to impact your federal tax bills over your lifetime. And then it's also going to impact your withdrawal rates early and late and help you potentially avoid sequence of returns risk. But just understand Social Security, it's all about how you claim, not when you claim. So for most individuals, if they just took their Social Security and they had like no other sources of income showing up on their tax returns, Social Security by itself would not be taxed. What makes it taxable is all of your other stuff that you have in your resources. So if you take this much from your IRAs and this much capital gains and then you have a pension, there's a formula that's called provisional income. And that could determine how much of your Social Security you're going to give back the second time. So really, for most plans, it's about how you claim it around your resources and your spending versus when you claim it, especially if you're married. Again, when you're married, when you're making Social Security decisions, you want to do what's best for the team, not necessarily what's best at that one moment for you. And then really focusing on not forgetting like retirement investment strategies before and after. So most of you employer plans, you're usually putting money in every week, 2 weeks, and you're buying shares every 2 weeks, and your employer's matching. So they're buying shares every 2 weeks with you. So you're buying as the stock market was down, you're buying low, and then you're buying high. That's called dollar cost averaging. And most people, when they retire, they're going to stop buying and start selling, which is reverse dollar cost averaging. So and then there's people that think like buying and selling, it's going to work the exact same way. My 401k averaged 9% retirement. I'm good to go. I've never failed to recover from one of those market dips before. So that's one of the areas that we kind of want to focus on is not misunderstanding like sequence of returns risk. So let's talk about traditional withdrawal strategies. We talked about some of those primary concerns and like some of the most it's like the iceberg illusion. Like if we don't see it, we don't think about it. So the traditional withdrawal strategy is basically saying a household has two sources of income. They're going to have one Social Security check or two Social Security checks, and everything else they need to support their lifestyle and retirement is coming from a bucket that is going to be subject to 100% federal taxes. So an example would be I have a married couple that they have $68,000 of Social Security coming in and about $70,000 of IRA withdrawals. That gets them to about $138,000 of income. Of that $68,000, $57,000 of their Social Security would be subject to taxes at the 22% rate. That's the 2024 married over 65. So they're in a 22% marginal rate and about a little under $11,000 in federal taxes was created. So again, traditional just basically means Social Security and IRAs. But if we look at some tax efficient strategies, it's like, hey, does it really make sense to put ourselves in a position where like we have Social Security and IRAs and like no other sources? Like what happens if taxes go up or what happens if the markets go down? So tax efficient just basically means you're going to position yourself so you have more tax diversification. So this would basically look like this. I have a household that maybe they retired at 64. They were living off their IRA withdrawals, doing Roth conversions, delayed Social Security a couple of years. Now they're going to take their Social Security. It's about $74,000 per year. They're going to have about $15,000 coming from IRAs, and now they're going to have about $30,000 coming from their Roth account. So that's about $119,000 of income that's coming in. There's literally no federal taxes due on any of that income based upon provisional income, standard deductions, married filing jointly over 65 in 2024. So of that $74,000 of Social Security, $12,800 of that would be taxable, but it's taxable at their tax rate, which is 0. So that's tax efficient. And again, the Roth conversion strategy to get them to that point, it usually takes 4 to 10 years. It just does not happen over time. And then next, if like, let's say you have a brokerage account, how would this look? So maybe you have Social Security $60,000, you have $12,000 of IRA withdrawals, $12,000 of capital gains, and like $35,000 coming from a Roth account. That's $119,000 of income. Of that $60,000 of Social Security, $14,500 would be taxable at 0%. So you got provisional income, capital gains, ordinary income, Roth, 0% federal taxes due, and all that 100% legal. Again, typically in this scenario, I would see they retired, they realized some capital gains, repositioned their investments to show qualified dividends. We're not anti 401ks or anti IRAs. We're just basically making sure you have complete tax diversification. So not everything's saved into a bucket of money that's going to make your Social Security more taxable. And if tax rates go up in the future, you might get hammered. Or if your surviving spouse outlives you, that he or she does not go into a higher tax bracket in retirement. So that would be like tax efficiency, how to potentially put everything together to start keeping more of all of your income. Going back to the taxes, let's talk about some overlooked aspects of retirement planning, which is the tax challenges. So potential tax challenges in the future. Number one, do you understand you're in business with Uncle Sam? Like your retirement accounts are in business. Do you understand you have a minority shareholder that has a majority vote on those accounts? Do you understand, like, if taxes go up, how would that impact you? If taxes stay the same, how would that impact you? If taxes go down, how would that impact you? A lot of the households that I talk to, work with, put plans together for, an example would be they're at the top of the 24% bracket when they're retiring, and they're going to be in like the middle or the bottom of the 24% bracket when they retire. Very rarely do I see someone go from like the 24 down to the 10%. The reason why that could happen is because maybe they're going to underspend in retirement, so they're going to stay in a low tax bracket, but they're underspending, or they're just living on their Social Security in cash. But most people are going to need their investment income to support their lifestyle in retirement. So those are some potential tax challenges. There's 4 of them. So understanding you're in business with Uncle Sam, understanding that they're a minority shareholder with a majority vote. Do you understand how this could impact you in the future if taxes were to go up, stay the same, or go down? And then number 4 is tax bucket diversification, which is basically saying getting money into tax deferred, which you mainly already have, and shoveling money over to the tax-free bucket or into the taxable brokerage accounts, and understanding how that will give you more probabilities of raising how long your money would last. So an example would be, if taxes go up, you're going to pull money from your Roth. You've already paid taxes. You don't have to sell as many shares to get your income. If there's a bear market in retirement, instead of selling IRA shares at a loss to get more net income, you can pivot and go to your Roths and sell. Let's say you need $6,000 from your investments. You only need to sell $6,000 of your Roth to get $6,000. So you don't have to sell as many shares at a loss. That's a great way to position yourself in those retirement years to hopefully get your money to last longer. And just to like finalize today's show, as we talked about some of the concerns, one of them was the withdrawal strategies and putting an order withdrawal plan together. So withdrawal strategy, this should be the goal. Number 1, maximize the amount of money you can spend in retirement. If your goal is to figure out how to spend your money appropriately and like retire with $1 million and die with $3 million is not your plan, order of withdrawal strategies would make sense. Number 2, receiving a higher lifetime after-tax income. Number 3, you just want to add longevity onto your portfolio. Number 4, if you want to reduce the taxes you pay over the course of your lifetime, an order of withdrawal strategy would 100% make sense. If you want to make sure you're eliminating or reducing your Social Security taxes in retirement, tax planning and order of withdrawal strategies would make sense. And then also, if you have 7 figures in tax deferred accounts, you've done a great job at saving, but now you kind of have a Medicare problem potentially, where you're going to be showing too much income or be forced to take out high RMDs, which will bump up your income. So you could be paying an additional $80,000 to $150,000 in Medicare premiums if you don't withdraw your money in the right order and execute a Roth conversion strategy to avoid that landmine in the future. I hope you guys enjoyed today's episode. Again, this was more of a rounded topic, just talking about primary concerns, frequently asked questions, but really the most overlooked aspects of retirement planning. It's the iceberg illusion. Remember, you just see your investments above the water. That's what we focus on. A lot of the stuff below the water, like taxes, income, order of withdrawal, maximizing investments, minimizing risks, it doesn't really get the attention because you can't see it. So good luck to everybody.
You've been listening to Retire Ready with Kyle Hammerschmidt. Planning your retirement starts now. We hope you've enjoyed the show. If you did, make sure to like, rate, and review. We'll be back soon.